Hi there! Another stock that may be undervalued. As you can see, Disney has declined by over 50% from its peak. And at the current price, many investors think that this business is undervalued. So in this video, you'll find out the outlook of Disney, and at the end its fair value, whether it's a great buy at the current price or not. So let's begin. You can see in this image the analyst estimates. Their revenue is expected to increase from 82 billion to 100 billion by 2025, and earnings are expected to more than double, from 3 billion to over 12 billion by 2025. They had around 11 billion in 2019, but because of the pandemic, the earnings went down, plus higher competition. Moreover, the analysts expect a dividend, $1.80 for this year 2023, and it is expected to increase a little to $1.87. I'm not sure if Disney will pay a dividend this year, but next year in 2024 you might expect a dividend from this company, as earnings are expected to be around 10 billion. Now let's see more. As you probably know, Disney has two main segments: Disney Media and Entertainment Distribution, and Disney Parks, Experiences and Products. As you can see, the revenue has increased by 8% quarter over quarter, and their operating income has declined by 11%, from 3.7 billion to 3.2 billion. That's why the stock price went down, plus other reasons. Now, if you look deeper into the segments, you can see that they have other sub-segments: linear networks, direct-to-consumer, and licensing and other. You can notice that the revenue from linear networks is declining, as there is this transition from cable to streaming, and the revenue from direct-to-consumers is going up, from 4.9 billion to 5.5 billion. So Disney is trying to balance this loss from linear networks with an increase in revenue from direct-to-consumers, especially their Disney Plus service. And you can also see that their operating income for linear networks has declined from 2.8 billion to 1.8 billion. And for direct-to-consumer, they have a loss of around 700 million, but it's lower than the last quarter. So that's a good sign. As they will attract more users to their platform, this loss will become a profit, as they have to balance the decrease in linear networks. And the second main segment, Parks, Experiences and Products, you can see that the revenue has increased by 17%, quarter over quarter. And also their operating income. As the pandemic passed, now they are starting to make more money from their parks. Now, the most important indicator you should follow is paid subscribers. They had a loss of 2% for Disney Plus. For ESPN Plus, an increase of 2%, and for Hulu, just a small increase. In total, they have around 240 million paid subscribers. So their future revenue and profits will depend a lot on this segment, direct to consumer, as linear networks is declining. People are switching from cable to streaming content. If they succeed to attract more users to their platform, then Disney will do great. The stock price will increase a lot. If not, then they will face more problems. Now, the revenue for direct-to-consumer has increased, not because they had more subscribers, because as you can see they had a loss, but because they increased the revenue per user. As you can see, the subscription for Global Disney Plus has increased by 13%, where they have the most subscribers, around 161 million, plus a small increase for ESPN Plus, and a decline for Hulu. And that's why the stock price didn't react to their increase in revenue. They reported a lower operating income, plus they're facing more competition from Netflix and other small players. Now, let's see the valuation. First, the risk. If Disney doesn't succeed to attract more users to its platform, then the fair value may be around 92 billion for a 10% annual return, or $50 per share. So the current market cap, there is still room for another decline if Disney doesn't succeed to attract more users to its platform. I don't think that will happen, because Disney is a well-known brand. We all like their stories, and I think they'll continue to grow. But they might face more competition from other players, such as Netflix. That's why you have to focus on the risk first. You never know what will happen. And the great scenario, where Disney may succeed, to attract more users to his platform and increase their earnings, then the fair value may be around 184 billion for a 10% annual return. So the current market cap, the stock price is undervalued. The fair value per share will be around $100. So if Disney continues to grow to balance the loss from linear networks, then the stock price is undervalued. And a normal case where Disney may make 12 billion in earnings and then to grow a little, then the fair value may be around 148 billion for a 10% annual return. So the current price, the stock price, is a little bit overvalued. You might get a return around 5% at the current market cap if this scenario happens. But if Disney grows more in the future, then the fair value may be around 180 billion. That's why when you invest, it's better to have a margin of safety. You never know what will happen. I believe Disney will improve its business as they have a new CEO, Bob Iger, and he is doing a great job. But you also have to be aware of the risk, especially competition from major big players such as Netflix, Amazon Prime, and other small players. And there is this shift from cable to streaming, and everybody is trying to gain more market share in that industry. So Disney is likely to face more competition in the future. That's why you have to be aware of that risk. Disney is a stable business. They are likely to make money in the future, but you have to be aware how much, because the market cap might not grow that much, and your return may not be that great. So you have to see for yourself if you like the risk and the reward. As I said, the market cap can also go to 184 billion. And if you have other questions or if you want me to analyze something new, please let me know in the comments.